Imagine standing in a crowded theater. Someone suddenly shouts, "Fire!" No one stops to verify, no one asks for evidence, everyone runs. Now imagine that same instinctual, unthinking panic, but with your money. That's exactly how most investment bubbles and crashes begin. People don't buy an asset because it's valuable. They buy because everyone else is buying. They don't sell because the fundamentals have changed. They sell because everyone else is panicking. This is herd mentality, one of the most powerful and destructive forces in finance. It's the tendency to outsource your thinking, to simply ask, what is everyone else doing? But the market rewards independent thought and punishes crowd behavior. Why? Because by the time something is popular, the real opportunity is often long gone. This isn't a personal flaw, it's an ancient survival instinct. Thousands of years ago, sticking with the group kept you alive. If the tribe ran, you ran too. Financial markets hijack this exact impulse. When you see stocks soaring and friends bragging about profits on social media, your brain interprets it as safety in numbers. But markets aren't the savannah. In investing, the crowd often arrives late. Emotion overpowers logic, and the reversal, the crash, happens precisely when confidence is at its highest. The market doesn't punish ignorance, it punishes unquestioned consensus. History is a graveyard of these moments. In the late 1990s, the dot-com bubble was fueled by a correct belief that the internet would change everything, taken to an insane extreme. Companies with no profits, no revenue, sometimes not even a product, were valued in the billions. Why? Because everyone was buying tech stocks. When the bubble burst, the Nasdaq fell nearly 80%. Investors weren't wiped out because technology failed. They were wiped out because they followed the crowd instead of the valuation. Then came 2008. The shared belief was simple. Housing prices always go up. Banks, homeowners, investors, everyone bought in. People bought houses they couldn't afford because the crowd felt confident. When reality hit, the same crowd that rushed in, rushed out. Trillions of dollars evaporated. More recently, we've seen it with viral stocks, where investment decisions are driven by memes and online hype. The crowd moves fast, but it doesn't move carefully. This behavior is powered by three powerful emotions. First is FOMO, the fear of missing out. It's the voice whispering, if you don't act now, you'll regret it forever. It pushes you to buy late and ignore risk. Next comes greed. It shouts, this time is different, blinding you to danger. And when the market turns, fear takes over. It spreads faster than logic, causing people to sell not because their strategy changed, but because the pain feels unbearable. This is how the crowd tragically buys high and sells low, not because they're unintelligent, but because they're human. Following the crowd feels comforting. If everyone is wrong, it doesn't feel like your fault. But investing isn't about comfort, it's about outcomes. As Warren Buffett famously said, be fearful when others are greedy and greedy when others are fearful. That isn't just a clever phrase, it's the core of behavioral finance. So how do you protect yourself? First, have a written investment plan. If it's not written down, it doesn't exist. Second, focus on fundamentals, not popularity. Ask yourself, does this make financial sense or is it just trending? Third, limit the noise. Constant news and social media amplify herd behavior. Less input often leads to better decisions. And finally, think in decades, not days. The longer your perspective, the less power the crowd has over you. The crowd feels safe, but it's often the most dangerous place to be. Successful investing isn't about being first, it's about being thoughtful. It's about having the courage to pause when others rush and the discipline to stay calm when others panic. So before your next move, ask yourself one simple question. Am I acting on evidence or on emotion? Because the biggest gains often come from thinking differently, especially when everyone else thinks the same.